Good morning, everyone. So now we are going to be looking at Rsk 4804, which looks at credit risk management. My name is Renos Musha, and this is my email, and also this is my contact details where you can either call me or contact me via WhatsApp as well. So we are a private and independent tutorial service provider where we assist students to go through the study units with guidelines on the assignments as well as revision as well until then. So what we do is that we prepare students to go through the curriculum and prepare them for the exam that they are going to be doing with UNISA as well. So our part in this case is basically preparing the students before they write their exams with UNISA as well. So which means that everything that you need between now and to write your exams, we will be able to assist you with everything that you need as well until you sit for your exams, which is going to be in January next year, or for those who are going to be writing upgraded exams, it will be until May, June next year as well. But after the January period, we give you access so that you're able to review the videos. But usually, even those students who are writing in the May, June period, we assist them as if they are writing in January period, then they can use the video material that we have available to prepare for their May, June exam as well. Is there a question? Yes. Is there a question? All right. So today we are going to assist. The first thing that we're going to do today is that we are going to give you a rundown of exactly what you're going to be expecting as we go through the curriculum. Then we'll also give you a guideline of exactly how to access material on our website. And then when it comes to your assignment, I see that assignment 1 for Rsk4804, which is credit risk management, is due on the 26th of April. So what we're going to do is that in the coming class, remember we're going to be having a class this Saturday. Then in the coming class, which is going to be the next week, Saturday as well, we are going to dedicate that class to go through assignment 1 for credit risk management. So we're going to dedicate that class to guide you in exactly how you should approach assignment 1 of credit risk management. Then after the next class, in the next class that comes after that, we will continue with learning unit 1, because remember, you see that for your curriculum, there are 12 learning units that you need to make sure that you cover. So you see that for your curriculum, there are 12 learning units that you need to make sure that you cover. And for learning unit 1, you see that learning unit 1 looks at credit risk and credit risk analysis and management. And you see that there are different textbooks that you're expected to cover under learning unit 1 as well. So which means that for each learning unit, take note that for credit risk management, there are 3 books that you're expected to cover. The first one is by C.P. Joseph. The second one is by Whitney. And the third one is by Bandyopadhyay as well, right? So these are the 3 books. So make sure that as you go through the study guide, as you go through the curriculum for Rsk4804, make sure that each study unit check to see exactly which textbooks and which chapter are we covering for each learning unit as well. And please make sure that you go through the study guide for each learning unit, because you see that for some of the textbooks, especially when you look at going through Whitney and Bandyopadhyay as well, it's not everything that you're expected to cover from those as well. So please make sure that you look at the learning outcomes from each of those chapters as well, of each learning units as well, because you need to make sure that you go through the learning outcomes and to avoid going through things that you're not necessarily expected to cover. So please make sure that you take note of that. So there are 12 learning units that you're expected to cover for credit risk management. And the first learning unit looks at credit risk analysis and management. Then the second learning unit looks at industry risks. And then the third learning unit looks at rating and scoring systems. Then the fourth learning unit looks at expected loss, loss given default estimations, and measuring probability of default. Then the fifth learning unit looks at an integrated view of firm level risks. The sixth one looks at financial risks. Then the seventh one looks at, seventh one is based on topic 3, which is based on credit portfolios risk and mitigants. So which means when you look at risk mitigants or from learning unit 3 or topic 3, you will see that for learning unit 7, you are going to be looking at credit derivatives. Then learning unit 8, you look at portfolio, major portfolio risks and assessment of credit risks. And then learning unit 9, you look at credit risk, validation of models, and the Basel Accords. Remember, all these learning units, it might seem as if it's a few chapters, it's only a few chapters, but remember, it's not based on the chapters. So you see that for each learning unit, they will refer you to a chapter by a different author. So which means that sometimes you might find that even one learning unit you might be asked to cover maybe even 3 or 4 chapters from different authors as well. So please make sure that you take note of that. Then topic 4 looks at credit risk, project, and working capital. So for topic 4, you look at learning unit 10, which looks at credit risk in project finance. And then you also look at learning unit 11, which looks at credit risk in working capital. And all these 2 are basically chapters in CP Joseph. So there's no redirection from one book to another. It's just a direction from one textbook, which is basically based on CP Joseph. Then moving on to topic 5, which is the last topic, which looks at the last line of defense and security. And you see that topic 5 is based on learning unit 12, which looks at security basics, collateral, and covenants. And it's also based on the book by CP Joseph as well. So please make sure that for every learning unit, so you see that the material that they're going to give you, that they give you there, there's the learning unit 001, which is basically giving you the overview. Then from learning unit 1 to learning unit 12, take note, go through the information given for each learning unit, because it will direct you to say, for this particular learning unit, go through this chapter by this author and go through this chapter by that author as well, so that you know exactly, so which chapter by which author are you going to be looking at as well. And remember, especially when it comes to Whitney and Bandyopadhyay as well, please make sure that you go through and check to see exactly which sections are you asked, or up to which page are you expected to go through. Because the lecturer tries to, because usually what I've noticed is that when it comes to those authors, they cover some of these concepts in a bit more in depth than what we're expected to cover for Rsk4804. So because of that, you need to be very careful when you go through the material covered by Whitney and Bandyopadhyay as well, because usually they go a lot more in depth than what we generally are expected to be examinable for Rsk4804. So please make sure that you take note of that. So are there any questions so far before we look at the breakdown of what we're expected to cover in study unit 1 or learning unit 1, and before I also give you a guideline of exactly how you can be able to access the material on our website as well? Any questions? Are there any questions? All right, so to access the material on our website, you will see that if you go onto our website, which is www.rminstitute.co.za, right? If you go onto our website to log in so that you're able to access your material as well, you click on student login. Then when you click on student login, if you don't have an account with us as yet, you go on to 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 remember, you go on to student login. Then from there you click on register. So this is basically to register for you to be able to click to access to create a user account on our website. So this is basically how you're able to create a user account on our website. So which means to create a user account, you need to indicate your email, you need to indicate the username that you want to be able to use for your user account, and then you need to create your password and also confirm your password to make sure that you didn't make a mistake as well. Then you press register, which means that on our side, that's when you are going to be able to get a notification that what a student has created a user account. Then in future, when you now want to access your modules, what you do is you now have to come back here, and then if you go on student login, which is that other tab, remember the student login tab is basically the tab that you're going to be that is this tab that you're going to be having there, right? So if you go onto the student login tab, you see that you need to now retype either the username that you indicated or your email. Then from there, you need to type the password. Then you click on login. And immediately when you click on login, it will now take you to the platform where you're able to access your individual user account as well. Then on your individual user account, you will see that once you press login, you will see that you are now going to be able to, you see that there will be your modules now are going to be indicating on your dashboard. So on your dashboard, you'll see that whichever modules that you've registered are going to be indicating on your dashboard. So now you indicate exactly whichever modules that you select the module that you have registered. Then this page gives you an overview of exactly what you should expect when it comes to RSK4804. Then from there, you also you click on curriculum. Now, when you click on curriculum, you see that it starts giving you all the videos from learning unit 1. Remember, we said that there are going to be 12 learning units, right? So you see that there is going to be videos under each learning unit from learning unit 1 all the way to learning unit 12. The videos are going to be there. So which means that if you're going to be looking at learning unit 1, you see that if you click on learning unit 1 there, you see that there's a video where you cover the book by Bandyopadhyay. There's a video where you cover the chapter from C.B. Joseph. And then there's a video that you're also expected to cover the book by Whitney. Then from there, if you scroll up further down, you will see that after learning unit 12, this is where you are able to access your textbooks. For example, if you want to be able to download these textbooks, which you are supposed to be using. Remember, we said that there are 3 textbooks you are expected to use. So if you want to be able to download the textbook either by C.B. Joseph, by Whitney, or Bandyopadhyay as well, after learning unit 12, there's a tab which says risk management books. And under that tab, you are going to be able to access what? These books as well. Which means that if you click on this particular tab, and then if you click to the Google Drive that you're being redirected to as well, you will see that the books for risk management are available, which means if you want to be able to download the book by C.B. Joseph, you just right-click there, then you say download. Then you have downloaded that particular book. Then if you want to download this one, you also click, then you say download. And if you want to download this one as well, you right click on the books, then you just simply say what? Download as well. And this is how you're going to be able to download those particular books as well. Are there any questions so far? Now, if you go further down, remember we said after the 12 learning units, that's when you're going to be able to download the books for risk management. Now, for those who are on the premium package, you are going to be able to immediately access the revision material, which is the books that are needed for revision material as well. But for those students who are on the diamond package or diamond option where you are paying on a monthly basis, we don't open up the revision material, or we only make it available after October. So which means towards the end of October, that's when we make available access for you to be able to access the revision material. And after October as well, that's when you are going to be able to access the videos going through this revision material, which means you are going to be able to access the videos for the 2017 papers, 2018 papers, 2019 papers in assignments, 2020 papers in assignments, 2021 papers in assignments, 2022 papers in assignments, 2023 papers and assignments, as well as some discussion class that we did for the module as well. So this is how you're going to be able to access your material on our website. Is there any questions on how to access the material on the website? Any questions? And remember to access the videos. For example, if you are going to be accessing the videos for Bandyopadhyay, which is basically the first chapter that we're going to be covering for credit risk management as well. When you click on that video, you see that it gives you the window for you to be able to now watch that particular video. So which means that you're going to be able to get the window, and on that particular window, if you click on if you press on play, then you're going to be able to access the video going through that as well. If you want to go on to the next one, you just click on the next one and it will give you access to videos. For example, in this case, it's going to be chapter 2 of CB Joseph, which is basically the second chapter that needs to be covered under learning unit 1. Are there any questions so far? Any questions? Anyone lost? Now, remember, we are giving students a 7-day trial period, which means that you are going to be able to access our website if you create on the under student login. If you create a user account, you are going to be able to access the material on our website, including the videos as well, for a 7-day trial period where you're able to go through the videos, and also you can also use these videos as well in preparation for the next coming classes. So even for those students who are on the diamond package option as well, what we do is that we make sure that the moment we always make sure that the videos for the next learning unit are made available in advance. Like, for example, after as you are finishing learning unit 1, you start seeing that the videos for learning unit 2 are already going to be available. Then as you are finishing learning unit 2, you see that videos for learning unit 3 are going to be available. So the videos are going to be made available as and when we go, but we always make sure that these videos are available even before we go through those particular learning units as well, because we always encourage our students to go through these videos and go through these videos in preparation for the classes, so that by the time you attend the class, you have so many questions to ask, and I'm able to clarify those questions so that you have a better understanding. So it's always preferable for you to go through the video in advance. Then when we go through that particular chapter or that particular learning unit as well, you will be knowing exactly where you need more explanation, and I'll be able to give you that explanation as well. So we always encourage you to utilize these videos, because remember, every session that we have, the video is recorded, which means even if you miss a class because of some commitments over a weekend as well, we always make sure that on a Monday following that, or following that particular weekend, we would have uploaded that particular video. And if the video is uploaded, it basically means that you will be able to catch up on the class that you missed using the video. And then if there's something that you still don't understand that you've covered in the video as well, feel free to contact me on WhatsApp so that I'm able to explain to you in detail. If I need to give you a call, I can also give you a call to explain whatever concept you need explanation on in detail as well. So don't hesitate to communicate with me if there's something that you don't understand or if there's something that you are struggling with as well. So please make sure that if there's something that you're struggling with, make sure that my doors are I'm always available for communication. Please just make sure that you make it available to me. If I need to say, if you're saying that there is this particular formula that I'm struggling with, and I can see that over WhatsApp I'm not able to give you a proper explanation, more than whenever I make time, I'm able to communicate with you as well and give you more information. So today is an introduction class. So we are going to be looking at one chapter, which is the first chapter under Learning Unit 1. So as you can see, under Learning Unit 1, from the information that the lecturer shared in the study guide, you see that under Learning Unit 1, we look at credit risk, analysis, and management. And under this as well, they give us the learning outcomes, which is basically what we expected to know after we've gone through these different chapters. And then they also say, study the following chapters of your prescribed book. And the chapters that we're expected to cover is Bandyopadhyay, which is chapter 1 of Bandyopadhyay, chapter 2 of Whitney, and also chapter 2 of C.P. Joseph as well. So these are the 3 chapters from the different books that we're expected to cover. Then when it comes to the overview of the unit as well, please make sure that you go through the overview of the unit where they say credit risk is the potential that a borrower or a group of borrowers will fail to meet their contractual obligations and the future loss associated with that. Furthermore, it might involve investments deteriorating in quality or going into default with consequent loss to the bank. It is therefore crucial that people with relevant or necessary skills and techniques be employed to enable proper assessment of credit risk. So a firm must put in place a quality credit risk analysis structure to ensure a clear understanding of the real risks involved when extending credit, which then should be priced appropriately. So when we look at credit risk management, the core principle of what we look at when we look at credit risk management is that you are basically looking at the equation where you look at the relation between assets is equals to equity plus liabilities, which is basically your accounting equation. And when you look at this accounting equation, we're basically saying that your assets are basically the securities that you're going to be investing in as well. Please take note. Rsk4804, when you look at credit risk management, take note that you are looking at the credit risk management from a lender's perspective. Remember, in every transaction from economics, we said there are those parties with excess funds, and then there are those parties with a deficit of funds. So those parties with excess funds, they're saying, I have more money than I need. So what are they going to do? They are now going to say, so how am I going to ensure that I give those parties who need money, right? But in exchange, they compensate me for that. So which means this is where the financial institution comes in. So there's going to be a flow of funds between those parties with excess funds, and then the financial institution gives those parties that money. And then there's also going to be a flow of funds backwards, and then the financial institutions also pay, for example, if you're going to put money in your bank account, you're expecting interest as well. So when it comes to this giving of money to the parties with the deficit of funds, this is where credit risk comes into being. Because remember, when you look at credit risk, you are looking at the risk that the party that you're lending this money might end up defaulting when they're supposed to pay back that money. Whether they're paying that money through interest or they're paying back that money through repaying the principal amount. So this giving of money to the party with the deficit of funds, it happens on the asset side of the financial institution. And a typical financial institution would be a bank. So for a bank, they lend money. So they lend out money. And also, they also invest in what? In security, right? They lend out money to customers and they also invest in securities. So the credit risk is that they might suffer losses from these activities. So the credit risk in this case is the risk that the bank might suffer losses from this activity of lending out money. So which means when you look at credit risk management, please note that we are looking at it from a lender's perspective as the financial institution, typically a financial institution. It can be anyone, but typically we're looking at it from a financial institution perspective. And a typical example of financial institution that we're using as an example in the textbook would be a bank. So in this case, a typical financial institution would be the commercial bank. Are we on the same page? Any questions? Anyone lost? So this relationship is what we look at here when you look at the activities of the bank. So credit risk is that if there's going to be any defaulting happening here or any failure to realize the gain from what is happening here, then it basically means that the bank is going to be suffering a loss, typically, which is the financial institution. So going back to what we're looking at there, they're basically saying, going back to the study guide, the lecturer says, a firm must put in, remember what they say, a firm must put in place a quality credit risk analysis structure to ensure a clear understanding of the real risk involved when extending credit, which then should be priced appropriately. And this is what is stated by CP Joseph. We will cover it as well. Now, remember we say, under introduction, they say, you have to work through chapter 1 of the prescribed book, Bandyopadhyay, with special attention to, so these are the sections in Bandyopadhyay that we need to make sure that what we take note of. So the sections of importance from chapter 1 of Bandyopadhyay would be the section which looks at credit risk drivers. Then you look at borrower level risk versus portfolio risk, management of credit risk in banks, the role of capital in banks, where you look at the difference between regulatory capital and economic capital. Then credit risk management framework. And remember they say we need to cover this, when you cover credit risk management framework, we need to cover this up to page 13, which means anything under this section after page 13 is not going to be relevant to us. So please take note. Remember I said, when it comes to Bandyopadhyay and when it comes to Whitney as well, you'll see that there are certain sections that the lecturer is asking you to go through. So be very careful and check the instructions carefully before you attempt those sections. Then they also ask us to look at the factors affecting credit risk. Then they also say any additional information relating to the topic must be sourced individually to add to your knowledge. Then they say, familiarize yourself with the following diagrams. So the first diagram that they ask us to look at is the diagram which looks at key drivers of risk. Then the diagram which looks at the structure of credit risk management, and also the diagram which looks at the causes of credit risk. In this case, this is the one from C.P. Joseph. Are we on the same page so far? Any questions? So you see that there are different sections we are expected to cover from each textbook. So there are different sections we're expected to cover from each textbook. Now, when you look at the textbook by Bandyopadhyay, remember this ask us to look at chapter 1 of the book by Bandyopadhyay. So they ask us to look at chapter 1 of the book by Bandyopadhyay. So looking at chapter 1, chapter 1 looks at the introduction to credit risk. So chapter 1 looks at the introduction to credit risk. And here they say, credit risk is the potential that a bank borrower or a group of borrowers will fail to meet its contractual obligations and the future loss associated with that. For most banks, loans are the largest and most obvious source of credit risk. So, however, other sources of credit risk exist throughout the activities of a bank, including the banking book and trading book, and both on the on and off balance sheet as well. Banks are also increasingly facing credit risk in various financial instruments other than loans, including acceptances, interbank transactions, trade financing, foreign exchange transactions, financial futures, swaps, bonds, equities, and options, in the extension of commitments and guarantees, and the settlement of transactions. So since the exposure to credit risk continues to be the leading source of problems in banks worldwide, banks and their supervisors should be able to draw useful lessons from the experiences. Now, when you look at this, we're basically saying the most common risks faced by banks is credit risk. That's why you see that when we later on look at chapter 15 of C.P. Joseph, which is one of the learning units that we need to look at there, you will see that when you look at the evolution of the Basel Accords, the first type of risks that the Basel Accords accounted for was credit risk. But then later on, they also realized that, you know what, credit risk is not the only risk that financial institutions are going to be faced with. That's why now we have to take into account, for example, operational risk or even market risk as well. So which means when you now look at the evolution of the Basel Accords, we're basically saying to have enough capital for the bank, we now need to make sure that we have enough capital to cater for not only credit risk, which is the most common one, we also need to cater for other types of risks as well. So here they say, banks should now have a keen awareness of the need to identify, measure, monitor, and control credit risk, as well as to determine that they hold adequate capital against these risks and that they are adequately compensated for risk incurred. So we're basically saying banks should make sure that they have enough capital to cater for these risks. Remember, we said when you look at the accounting equation, for a bank, we're basically saying the credit risk is emanating from here. which is going to result in a loss, for example, to the bank. Right? The credit risk is emanating from here, which will result in a loss to the bank. So when you look at credit risk management, we're basically saying if in the case of a bank, which is a lender, we must make sure that we have enough capital available to cater for these possible losses. Because the last thing that you want is that if there is not enough capital available to cater for these potential losses, what's going to happen? It means the bank is not going to be able to operate as continue as the going concern. Because what is going to happen? The last thing that any economy needs or any financial system needs is a situation where the bank fails to cater for these losses, like what we saw during the recession, or in some instances after the recession as well. Like, for example, when you look at what happened with Silicon Valley Bank, or in South Africa, if you look at what happened with the VBS Bank as well, where there was not enough capital to cater for these losses. And what are banks' liabilities? One common and most important bank liability is money contributed by depositors. If you're going to be depositing money in the bank, it means the bank is owing you money. So it's a liability to the bank. So which means when you look at the evolution of the Basel Accords, our aim is to ensure that we have enough capital available to absorb these losses so that they don't end up affecting the depositors' money. Because remember, the depositors are basically saying, I'm just giving you money. I'm not expecting to be taking risk, and because I'm just giving you money so that you keep it safe for me. Which means that when I need that money, I should be able to access that money. So which basically means that if the bank does not have enough capital to absorb these losses, it means that the depositors are going to end up losing out. And this is where you find that the moment people see that, for example, you see what happened with the VBS Bank, where there was a run for the bank, where people were now queuing, waiting for their money. And at any given point in time, in most cases, the bank would not be having that money available. Mainly because, remember, for every deposit that the bank makes, they lend it out to someone else, and then they keep, for example, in South Africa, they're supposed to keep what? 10%. Then the rest, they lend it out as well. Minimum regular capital would be 10%, which means that the rest they can be able to lend it out as well. Which basically means that because of this, what is going to happen? The last thing that you want is for the run for the bank, the depositors want their money, and the money is not going to be available because what? The capital has not been able to absorb these losses. And what is going to happen? Then people lose confidence in the financial system. And now people are going to be putting their money under the mattress. So which means the financial system is based on confidence. And to maintain confidence, it means the bank needs to show that there is enough capital available to absorb these potential losses. And this is why you see that there's a continual evolution of the Basel Accords. The main thing is to ensure that there's enough capital available to absorb these losses so that we are more of giving a guarantee for it, not necessarily a guarantee, but some sort of a guarantee that the depositors, when they want their money, is going to be available to them when they want the money. Any questions? Any questions on what we've covered so far? Moving on. So which means to ensure that they have enough capital available to mitigate these losses or potential losses that they are going to be potentially arising from their risk exposures. That's why you see that they say, in this case, to repeat, since the exposure to credit risk continues to be the leading source of problems for in banks worldwide, banks and their supervisors, the supervisors typically would be the central bank. So the banks that they're talking about there is just the general banks, like for example, commercial banks, and then the supervisors would be the central bank, like for example in South Africa would be South African Reserve Bank, right? Where they say should be able to draw useful lessons from the experiences. Banks should now have a keen awareness of the need to identify, measure, monitor, and control credit risk, as well as to determine that they hold adequate capital against these risks and that they are adequately compensated for risk incurred. So it's all going back to the accounting equation. Any questions so far? Any questions? So they go on to say, by definition, credit risk is the risk resulting from uncertainty in the counterparty's ability or willingness to meet its contractual obligations. So credit risk relates to the possibility that loans will not be paid or that investments will deteriorate in quality or go into default with consequent loss to the bank. Any questions before we move on to the next section? Any questions? Any need for clarity? In the next section, we look at the major drivers for credit risk. And here they say, credit risk arises because in extending credit, banks have to make judgments about a borrower's creditworthiness, its ability to pay principal and interest when it falls due. So this creditworthiness may decline over time due to the change in its financials, poor management by the borrower, and changes in the business cycle, such as rising inflation, recession, weaker exchange rates, and increased compensation. So the major drivers of credit risk are, and the first major driver that they discuss is default risk, where they say, when you look at default risk, the obligor fails to service debt obligations due to the borrower-specific or market-specific factors. So one of the major drivers of credit risk is default risk, where we are saying the borrower is either going to fail to pay the principal when it falls due or pay the interest when it falls due. The next one is recovery risk, where they say recovery post-default is uncertain as the value of the collateral changes unexpectedly. So when we talk about recovery risk, we're basically saying, in the case where the borrower defaults on their obligation, in the case where the borrower is going to default on the obligation, two things are going to happen. It's either the bank, which is the financial institution, is going to be able to recover, the amount of money that they're being owed. Like, for example, if they're being owed R1 million, we're going to say, so of this money that is being owed of R1 million, if the customer is deemed to have defaulted, how much of this million are they going to be able to recover? Then, if they're not going to be able to recover, then there's going to be a loss given default. So if default happens and they're not going to be able to recover, it means there's also going to be a loss that the bank is going to be incurring as well. So in the case of default, two things are going to happen. It's either there's going to be recovery or there's going to be a default, which basically means as a percentage, well, we can also say your recovery rate can be given as 100%, minus the loss given default. This we can just put it as loss LGD, which is the loss given default. So recovery rate can also be given as 100% minus the loss given default. So because they are interchangeable, it also means the loss given default can also be given as 100% minus the recovery. So if you want to find out exactly what your loss given default is, you're going to say, how much am I going to recover as a percentage? So 100% minus what I'm going to be able to recover as a percentage will tell me exactly how much am I going to lose out in the case of what? In the case of default. Are we on the same page? Any questions? Anyone lost? Moving on. They also talk about spread risk as a major drivers of credit risk. When they say, when you look at credit risk, they say, so spread risk, they say, credit quality of obligor changes leading to a fall in the market value of the loan. So what does that mean? We're basically saying when there is default, the quality or the probability of the obligor repaying their money goes down. So when there's default, the probability of the obligor repaying their money goes down. So which means when we talk about credit spread, spread risk, we're basically saying when you look at interest rate, if you still remember from undergrad, you used to say your nominal rate of interest is given as the real rate of interest plus inflation premium plus risk premium. So your nominal rate of interest is given as the real rate of interest plus inflation premium plus risk premium. Now, one of the risk premiums that you need to account for is one of the risk premiums, not the only risk premium, but one of the risk premiums that you need to account for is the spread risk. Now, when it comes to the spread risk, we're basically saying if you are, for example, going to be comparing a particular instrument which is risk-free, like, for example, these 3-month instruments issued by the government, what do you call them? Treasury, what do you call that? Treasury bills, right? Typically, when you look at this formula, your real rate of interest plus inflation premium gives you the risk-free rate. And an example of an instrument that is used as an estimate of the risk-free rate would be your treasury bill. So they're basically saying, when you look at the spread risk, we're basically saying the more the credit quality of a borrower declines, what do we see? The risk premium is going to be increasing, which means the difference between the nominal interest of the instrument and the interest of the treasury bill is going to be increasing because the risk premium is what? It's increasing. So which means in this case, when the risk premium goes up, the interest rate on that particular instrument, which the credit quality has gone down, is expected to increase as well. which means now when you're comparing it with the interest on a risk-free instrument, the interest is going to be charged at a higher rate. So that's basically what they look at when you look at what? Spread risk. Because now your interest is going to be higher because you have to take into account that higher risk premium because the credit quality has gone down. So when the credit quality goes down, it basically means that the market value, when the interest rate goes up, we know that the market value of your instrument, especially, for example, a bond, goes down. So when the interest rate goes up, we know that the market value of an instrument, for example, if it's a bond, it goes down because the relationship generally is something like this. The market value of a bond and interest rate. Where, for example, if the interest rate is at this particular percentage interest rate, the market value of the bond, let's say, for example, it's 1,000 rand. We're basically saying that if the risk premium goes up because there is more credit spread that you need to account for because the credit default risk has gone up as well, credit risk has gone up, it basically means that the interest is going to be higher. But we know that for a particular bond, when interest rate goes up, the market value of the bond is expected to decline. So the market value of the instrument, if it's a debt instrument, is expected to decline when interest rate goes up because there's more risk. Are we on the same? Are we on the same page? Any questions? Next, we also need to cater for concentration risk. So if you check in the article, in the book, they also talk about concentration risk, where they say overexposure to an individual borrower, group, entity, or segment results in concentration risk. So which means when you look at concentration risk, let's say, for example, as an investor, you are given two options, right? Let's say, remember we're talking about, in this case, it's a bank having these lenders, right? They're having these borrowers, right? They lend to customer A, and then they lend to different customers as well, right? Let's say, for example, you have Bank A. Bank A only has two customers. They have customer X, which they've lent out 50,000, and they have customer Y, which they've lent out 50,000. So the total portfolio value of 100,000. Then we also have Bank B. And for Bank B, they have customer G, which they have lent out, let's say, for example, 10,000. Customer E, 10,000. F, 10,000. F, G, 10,000. H, 10,000. I, 10,000. J, 10,000. K, 10,000. L, 10,000. LM, 10,000 as well. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The total portfolio value of 100,000. What do we see? Looking at and comparing these two banks, if one customer of Bank A defaults, their risk exposure is going to be on the 50,000. But if one customer of Bank B defaults, their risk exposure is only going to be on the 10,000. So which means, what do we see? So do you see that Bank A has more concentration risk than Bank B? Because Bank A is only concentrated by giving out credit to only 2 customers. And the risk here, which is the concentration risk, is that if one customer defaults, the money at risk is 50,000. But for Bank B, if one customer defaults, the money at risk is only 10,000 of the total 100,000 in the portfolio. So do you see what they mean by concentration risk? Is there any question? Any questions? Anyone lost? Moving on. They also look at correlation risk, where they say common risk factors between different borrowers, industries, or sectors, which may lead to simultaneous defaults. So that's basically what they mean by correlation risk. So now, when it comes to correlation risk, we're basically saying when it comes to correlation risk, we're saying the correlation between 2 instruments varies between -1, 0, and +1. Oh, sorry. So when it comes to correlation risk, we're basically saying that the correlation between 2 instruments varies between -1, 0, and +1. If the correlation is at -1, we say the instruments are perfectly negatively correlated. And if it's at +1, we say they are perfectly positively correlated. If it's at 0, we say there's no linear correlation. Now, when you look at this correlation, as a typical example, let's say, for example, you have asset X and Y, right? So you have asset X and Y. If asset Y performs in this direction, and then now we want to see exactly, so what is happening with asset X? So if they are perfectly negatively correlated, it means when you look at, for example, if it's returns over time, if they are perfectly negatively correlated, we're basically saying that if one is going up, the other one is going down by exactly the same amount. So which means they are basically moving in the opposite directions. So that's why they are perfectly negatively correlated. Their movements are basically moving in unison, perfectly in the same direction and perfectly by the same amounts. Then, if the correlation coefficient, where you look at the returns over time, remember we said for asset Y, it can be moving in this direction. Now, if they are perfectly positively correlated, we're basically saying that when asset Y is having an upward increment, asset X is also having an upward increment. And they are basically moving in the same direction by the same amounts. So that's why we say the assets returns are perfectly positively correlated. Now, the risk when it comes to, remember we're saying here, we are looking at elements where you look at major drivers of credit risk, isn't it? So when you look at correlation risk, this is what we're saying, for example, if you're now looking at performance of the portfolio between, for example, period 1 and period 2, right? What do we see? If they are perfectly negatively correlated, it means when one is suffering a loss, the other one is having a gain, which means that the losses are going to end up what? More or less netting off each other, right? So the loss and the gain are going to end up netting off each other, right? Then, if they are perfectly positively correlated, we're basically saying that if you look at between period 1 and period 2, what do we see? When asset X is suffering a loss, asset Y is also, when asset X is suffering a loss, asset Y is also suffering a loss as well. So the correlation risk here is that your portfolio is going to end up having negative returns in the periods where they are both having a downward spiral. So this is basically what they mean by correlation risk. So what does that mean? Correlation risk increases the more you are going in this direction. So the more you are going in this direction, correlation is increasing. Which means the opposite of that, correlation is decreasing the more you're going in this direction. So the more you go in this direction towards -1, your correlation risk is going to be declining. So your aim in managing your portfolio is to ensure that your correlation coefficient is close to -1. So which means the closer your correlation coefficient is to closer to -1, the more diversified your portfolio is. So to diversify your portfolio, you need to ensure that the correlation coefficient of your assets in your portfolio is closer to -1 as much as possible. So that's how you're going to be able to now reduce your correlation risk by diversifying your portfolio, by ensuring that your correlation coefficient of your assets in the portfolio is going to be closer to -1 as much as possible. Any questions? Are there any questions? Anyone lost? All right. Can we take a 10 minutes break until 12:30? So can we take a 10 minutes break until 12:30? Then at 12:30, we move on to factors affecting credit risk. So can you take a 10 minutes break until 12:30? Then at 12:30, we look at factors affecting credit risk. So can you take a 10 minutes break until 12:30? Can we continue? The next section we're looking at looks at factors affecting credit risk. And the first factor which affects credit risk, when you look at the factors affecting credit risk, well, they say this is where we're looking at expected and unexpected losses arising out of adverse credit events as well. And when you look at these factors affecting credit risk, they are looking at the exposure at default, probability of default, and also the loss given default. And then from there, we also look at the correlations as well in case of what? Of default as well. So where these factors are coming from that affects credit risk, we see that so when you look at these factors affecting credit risk, they are all coming from the understanding that the losses that a bank will suffer. So when it comes to the losses that a bank will suffer, there are two types of losses. The first type of loss is your expected loss. And you see that later on in the other chapters, we're going to check to see exactly, we're going to analyze in detail how to determine this expected loss. Now, what makes up this expected loss? Your expected loss is calculated as your exposure at default multiplied by your probability of default multiplied by your loss given default multiplied by your term to maturity. And this is how you determine your expected loss. So in this case, the other type of loss that you're going to be incurring is the unexpected loss. But the unexpected loss, we'll look at it later on. So when it comes to these two different types of losses, the expected loss, we can account for this particular expected loss because we can determine the expected loss by looking at the exposure at default, by determining the probability of default, by determining the loss given default, and also by determining the check to see exactly how long do we have until maturity date. So this will give us the loss given default. Now, how do we account for this particular expected loss? This expected loss, we are going, remember we said previously, we said your nominal rate of interest is given as your real rate of interest plus inflation premium plus risk premium. So which means we also said Your real rate of interest plus inflation premium is your risk-free rate. So the risk rate, there's not much that we need to account for. What you are going to be needing to account for is the risk premium. So in this risk premium, this is where we are now accounting for the expected loss. Because remember, the expected loss will tell us exactly how much risk premium we need to account for. Because the higher the risk premium, the higher the interest rate that we're going to be charging the customer. So which means your nominal rate of interest in this case is the interest rate that we're going to charge the customer. So that's the interest rate that we're going to charge the customer. And in some instances, this is basically the purchase price of credit. To say, if you want to borrow from us, this is how much interest we're going to be charging you. How they come about to this interest rate, they are going to be taking into account the real rate of interest plus different risk premiums there. So which means in this case, this pricing of credit takes into account the expected loss. So this pricing of the credit takes into account the expected loss. Now, if this pricing of credit takes into account the expected loss, why should we be worried now? Which means, remember we said your assets is equal to equity plus liabilities for the bank. And remember we said from these losses, from the asset, we're going to be expecting to suffer losses, isn't it? And they are going to be catered for using capital. So the capital of the business is there to cater to say, in case the losses are more than what we expected, which is the unexpected loss. So in case the losses are more than what we expected, do we have enough capital to cater for these unexpected losses as well? So which means these total losses, expected losses and unexpected losses. The capital that we're trying to maintain here is trying to cater for these total losses, especially the unexpected losses. Because remember, if we have a lot of unexpected losses, what is going to happen? The capital is not going to be able to be enough to cater for these unexpected losses. And then we end up affecting depositors. The last thing that we want as a bank is to affect the depositors. So which means we need to try to protect these depositors as much as possible. So do you see where the expected losses and the unexpected losses comes in when it comes to the accounting equation of the bank? Any questions? Any questions? Now, in this chapter, I know the way they bring in these things, it was more uniformly introduced if you just look at CP Joseph on its own. But because of the changing of the textbooks, because of they're obligated to change the textbook as well, they have to introduce other textbooks as well. And because of that, I feel like the curriculum is a bit back and forth, but it's fine. So which means in chapter 1, we're now looking to say, so what really makes up this exposure at default? What makes up this probability of default? What makes up this loss given default? Which contributes towards what? Expected loss. Because these are the factors that affect credit risk. Are we on the same page? So your expected losses are already accounted for when we price this credit. So we already know that in case we suffer a loss, this is how much losses we're expecting to cover. But we know that the capital of the business should be enough to cover these expected losses and unexpected losses as well. So if we suffer these unexpected losses now, the idea now is linking to the accounting equation to say we need to make sure that in case of these unexpected losses as well, we have enough capital. That's why you see that the Basel Accords are continuously evolving, because over and above having capital to cater for credit risk, we know that we also have to cater for other types of risks as well. Now, looking at these factors affecting credit risk, they say the first factor is the exposure at default. And here they say, in the event of default, how large will be expected outstanding, will be the expected outstanding if the default takes place. So the basis for exposure at default is the outstanding and the external limit booked in the official process systems. So the exposure at default has to be estimated on transactional level from historical default information available in the bank. For term loan with full utilization, where there is no chance of further increase in the loan exposure in excess of the set limits, the exposure at default will be equal to the outstanding amount. However, for lending product facilities such as overdrafts, revolving line of credit, that are characterized by an external limit and average of the utilization of the month, the exposure at default is going to be equal to your outstanding amount plus the plus the UGT, which is basically plus multiplied by the free limit as well. So which means in this case, the UGT is basically your usage given default. So you're basically trying to check to see exactly, so how much are we expecting to be, is the client expected to have used in case they end up defaulting as well. So here they say where UGT is usage given default, or the credit conversion for CCF as well, cash conversion, credit conversion factor. So a portion of the unutilized or free limit has been considered in the exposure at default calculation. It's because it is expected that a counterparty close to default tends to increase its utilization, while the bank will work against this by reducing available limits. Under normal circumstances, for exam and assignment purposes, take note that when it comes to the exposure at default, normally it's just going to be equal to the outstanding amount, unless otherwise stated. So the exposure at default is just going to be equal to the outstanding amount. They don't make it too complicated for Rsk4804. So whatever they say, this is how much we've given the customer as the loan, that's the amount that you're going to be using as the exposure at default when you're calculating here expected loss. So for Rsk4804, they don't make the ascertainment of exposure at default that difficult. Whatever they say is the loan amount that they're giving the customer, that becomes your exposure at default. Next item that we're going to be looking at is the probability of default, where they say the probability that the obligor or counterparty will default on its contractual obligations to repay its debt. So it is generally estimated by reviewing the historical default record of loans in a pool with similar characteristics, and from the temporal movement of the gross non-performing assets from standard category of advances. And this is how you determine the probability of default. And you'll see later on in the coming chapters as well, how there are different ways that you also determine the probability of default as well. And we're going to look at it in detail. The next element looks at the loss given default, where they say the percentage of the exposure the bank might lose in case the borrower defaults. And usually it is taken as the loss given default comprises the fraction of the exposure of default which will not be recovered by the bank following default. So it comprises the actual cost of the loss along with economic costs associated with the recovery process. Historical evidence shows the loss given default is lower for loans with higher value, more liquid, and senior collateral. Generally, when it comes to the loan given default, remember I also explained this as well in the previous diagram, where I said the loss given default simply can be given as 100% minus the recovery rate. So if they don't give you the loss given default, if you say 100% minus the given recovery rate, they will give, this is how you're able to ascertain the loss given default. For Rsk4804, they don't make it that complicated. If you're only given, expect that it can also be given as 100% minus the recovery rate. But there's another way that you're also going to be able to determine is all the loss given default, but we'll look at it later on when it comes to analysis of loss given default in the coming study units as well. Any questions before we move on? Any questions? The other factor looks at default correlations, where they say default correlations measure the possibility of one borrower to default on its obligations and its effect on another borrower to default on its obligations as well. So this default dependence is due to the common and diversifiable factors. So default events are not independent. Defaults may occur in clusters due to correlation across sectors, regions due to common systematic factors. So correlations of default add to the credit risk when a portfolio of loans and advances is in consideration vis-a-vis single loans or advances. When many borrowers default together, correlations effects become more pronounced. Thus, the correlation contributions need to be considered carefully in the risk management and management of credit portfolio. So over and above these three factors, we also need to take into account the correlations between the loans as well, because it also contributes towards what? The risk, credit risk. Any questions? Any questions regarding these factors? Any questions? On the next section, they also say credit risk is generally measured as a risk on individual counterparty transaction or default risk and portfolio risk. So the credit risk of a bank's portfolio depends on both the external and internal factors. So the elements identified for credit risk are shown in chart 1.1. So remember, chart 1.1 is basically summarizing the key drivers of credit risk, where they say the key drivers of credit risk can either emanate from portfolio risk or transactional risk. If it's portfolio risk, this is where you look at concentration risk, or you look at intrinsic sector specific risk, where you're saying, so what is the factors that are specifically affecting the sector that you're going to be considering investing in? Like, for example, what are the risk factors that are common in the mining sector? What are the risk factors that are common in the manufacturing sectors as well? Then when it comes to transaction risk, this is the risk that if you invest in a particular instrument, it can now end up being downgraded. And remember, if it's downgraded, it basically means that the credit quality also going to go down. And the transaction risk is also determined on the recovery risk, because remember, the recovery risk is also linked to the loss given default. To say, so what is the probability that you're not going to be able to recover anything, or you're going to be able to recover very little from what you've invested? And your transaction risk is also going to be coming from what? Default risk as well, which is the probability that the customer is going to end up defaulting on their principal amount or interest obligation as well. So is there any question regarding chart 1.1? Any questions? Next, we look at borrower level risk versus portfolio risk. So we look at borrower level risk versus portfolio risk. And yet they say, when making credit decisions during lending, there is always a risk that the borrower might default on its contractual obligations to repay principal and interest. So the risk factors that are unique to the borrower causing them to default are called borrower-specific default risk. So borrower-specific risk can be measured by using credit rating. That is where you look at the borrower-specific probability of default or facility-specific loss given default. And also tracking the borrower's rating movements to say, so this borrower, is their credit quality going up or is it going down? They're also going to say portfolio risks arises from the composition of or concentration of banks' exposures to many assets to various sectors. So systematic factors are the external risk factors that affect the fortunes of a proportion of the borrowers in the portfolio. So concentration risk results from having a number of borrowers in the portfolio whose fortunes are affected by a common factor. So this common factor is also called correlation factor. So systematic factors correlate the portfolio risk to changes in the macroeconomic environment. Like, for example, if there's going to be GDP growth rate, unemployment rate, or fiscal deficit as well. So credit risk modeling is being extended into evaluating portfolio risk, especially in the areas of commercial and industrial loans, management of asset allocations in the loan portfolio, and portfolio monitoring. So the portfolio risk is influenced by idiosyncratic, borrower-specific risk, and external systematic risk. So the internal borrower-specific risk can be managed by adopting proactive loan policy, good quality credit analysis, prudent loan monitoring, and sound credit culture. So the external risk factors can be managed by diversifying the portfolio, correlation analysis, setting the norms for borrowers and sector limits, and through effective loan review mechanism and portfolio management. And we're going to look at this in more detail when we look at I think it's chapter 2 by Whitney, which is the other chapter that we need to cover under unit 2, where we now say, before we give credit to a particular customer, not even before, what is the credit process from the point where we consider giving the credit, there's an application, we approve, we review, and then we do the continual reviewing of the credit process as well, of the debt that we've lended out to the customer as well. Any questions so far? Any questions? On the next section, we look at the importance of management of credit risk in banks. And here they say, credit risk management is important for banks because of the following reason. And the first one is where we look at market realities. So the first one is where we look at market realities. And here they say, structural increase in non-performing assets, where they say, these result in massive write-downs and losses. So the increase in stressed assets badly hit the banks as provision and capital requirements go up sharply, which squeeze the profit level. So which means the reason why we need to continually monitor and review our assets is mainly because over time, market factors, they end up affecting our borrowers as well, which is basically our credit assets, isn't it? And because of that, it basically means that if your book is made up of credit assets which are badly performing, what does that mean? It basically means that the value of your risk-weighted assets is going to go up, which means your capital requirement is also expected to go up as well. The next market reality looks at higher concentrations in loan portfolios, where they say overexposure to a borrower or related group of borrowers can pose risk to the earnings and capital position of a bank. in the form of unexpected losses. So higher loan concentration makes banks vulnerable during economic downturn due to incidents of clustered defaults. Another market reality is capital market growth, where they say it produces a winner's case effect due to the increased competition as many companies have alternate channels to raise funds. So which means in this case, when the economy is having economic growth as well, what does that mean? It basically means that you are now going to be having companies that are performing all over the place. And if companies are performing all over the place as well, it basically means that they are going to be fighting for those particular funds as well. The next one is increasing competition, where they say higher competition among banks to book big loans, leading to lower spreads and net interest margin. So this is a primary concern for top management in banks as well, because they are now looking at it from an overview perspective for the bank. Next, we look at declining and volatile values of collateral, where they say a decline or volatility in collateral value warrants greater amount of credit risk due to uncertainty in loan recovery. So when they talk about declining or volatility value in collateral, remember we said here, your loss given default is given as 100% finance recovery rate. One way that the bank can try to ensure that their recovery rate is high is through asking for collateral. But now, if this collateral is also going to be affected by what's happening in the market, it means that the value of the collateral is going to be low. Like, for example, if your collateral is going to be 15 million in shares, for example, right? It basically means that the value of shares, we know that over time it goes up and down as well, right? So which basically means that the volatility of the collateral is going to be very high. And the risk here is that what happens now if the share values goes down to a value of 5 million, but the customer is owing us, for example, 10 million. It means we're going to be running the risk of what? Losing out as well. So this is basically where the volatility of collateral risk basically comes in. Are we on the same page? Then the last item that we look at there is growth of off-balance sheet credit products. And here they say the rapid growth of off-balance sheet products like various structured products, for example, collateralized debt obligations, credit derivatives, to etc. to trade the credit risk positions has heightened the need for more prudent bank regulation. Because remember, the more you use these instruments, we saw that if the trader does not understand the risk underlying these instruments, the organization is going to end up what? Being overexposed as well, which means that if they are overexposed, it basically means that these off-balance sheet securities are going to end up what? Affecting the profitability when they what? If we are going to be sitting on a deficit, like for example, if we're going to be trading in derivatives, but then from our trading positions there, we suffer a loss. It basically means that these losses now are going to be absorbed in the statement of comprehensive income, which is basically going to affect what? The performance of the bank as well. So these are the different market realities that we need to take into account. Are we on the same page? Any questions regarding these market realities? The other factors that we need to take into account would be the changing in regulatory environment. So which means any change in regulations have to be filtered in because they also affect what? Credit risk as well. So any change in regulation have to be filtered in because they also affect credit risk. That's why you see that these changes, they are basically filtered in to the market so that they also make sure that the market is prepared to take for these changes in the regulatory environment gradually over time as well. The next factor that we need to look at is institutions' risk vision. And when you look at institutions' risk vision, the first factor that you have to take into account is this way they say capital is a scarce resource and need optimal utilization. So the success or return in a project in a financial institution is observed by its stakeholders. So if the financial institution is engaging into a new business or expanding its existing business, it requires capital as a buffer against what? Unexpected risk of losses, as mentioned when we looked at the capital at the accounting equation there as well. Then they also say, improve risk-adjusted return on capital and risk-based pricing, where they say a risk-adjusted performance measurement framework would guide it to link its business growth targets, risk management processes, and also shareholder expectation as well, so that you are able to now know exactly what really is the hurdle rate that we need to be able to meet so that we can use it as a what? Performance benchmark. Any questions so far? Any questions? On the next section, we look at the role of capital in banks, where we look at the difference between regulatory capital and economic capital. So what does that mean? In South Africa, when you look at the accounting equation, the regulatory capital is basically the minimum capital that you need to set aside to absorb this unexpected loss in case they arise, isn't it? Remember, we said the expected losses are going to be absorbed by us pricing already on this date. But the unexpected losses are the ones that we're now going to be very much worried about. And need to make sure that what we have enough capital available to absorb this capital as well. So in South Africa, the regulatory capital is 10%. So 10%, at least 10% of the risk-weighted assets is going to be the capital requirement. So at least 10% of the risk-weighted assets should be the capital requirement. So at least 10% of the risk-weighted assets should be the capital requirement. So it means we are saying, according to the prescribed capital requirements by the supervisor, in this case being the central bank, which is South African Reserve Bank, are basically saying 10% of our risk-weighted assets is what we should set aside as capital to absorb these unexpected losses. Now, economic capital is that capital that the bank is saying, for us to be fully profitable, this is the capital that we need to make sure that we set aside so that we're able to maximize the shareholders as well. So where the difference is and where the issues usually arise when it comes to banks is, let's say, for example, the value of the risk-weighted capital is 1,000 rand, right? So it means to absorb these potential losses, we must set aside 100 rand as regulatory. So regulation is saying we must set aside at least 100 rand so that if there's unexpected losses there, we have enough money to set aside. But what does that mean? Instead of keeping money within the banking system itself, ideally, the more money you pump towards income generating activities, the more money you have available. Because remember, this 100 rand, it basically means that we're also going to be saying our cash and cash equivalent or something equivalent to this, for example, would be an amount of 100 rand, so that in case we suffer losses there, the cash is available to absorb these losses as well. For example, if it's going to be cash and bank, whatever it is that you're putting in as the reserve that is coming from what? Foreign capital. But now, when it comes to economic capital, we're basically saying, instead of us normally, you make more money if you take out more money to use yourself. So which means when it comes to equity and liabilities, the more leveraged you are, the more leveraged you are, the more you are going to be able to make more money for yourself. So which means in this case, for example, if your assets are worth 1,000, we're basically saying that in this case, 10% is going to be 100, which means probably to finance your other assets, we have money coming from depositors, which is the 900 rand. So we have 900 rand coming from the depositors. So if your assets, in this case, are going to be worth 1,000, it means we're basically saying equity is going to be 100. For example, depositors are going to be 900 rand. So in case there's a loss of 100 rand, we already have enough capital available to absorb this for regulatory purposes. But normally, what do we see? Remember, we know that the more leverage you are, the more you're using other people's money to make money. So if you're using other people's money to make money, the more your profits can also exponentially increase. So your profit for the bank exponentially increase when you use other people's money to make more money. So which means in this case, let's say, for example, the bank says we want our economic capital to make more money, to maximize our profits. We want our economic capital to be, let's say, for example, 5%. It means 50 rand is going to be contributed by the owners of the business, and then the other 950 rand is going to be coming from depositors. So the other 950 rand is going to be coming from depositors. But now, the risk here is that if there's going to be a loss of 100 rand, what's going to happen? We only have capital of 50 rand available, which means to cover this loss of 50 rand, only of 100 rand, only 50 rand is going to be available, which means the other 50 rand is going to end up affecting what? The depositors. So this is where there's always going to be a conflict between regulatory capital, which is the capital that is prescribed by the supervisor, and in economic capital, which is basically the capital that they're saying for the bank optimally to operate, how much capital should we maintain in the business as well. So under normal circumstances, a bank is not allowed to keep its economic capital to be less than regulatory capital. Why? Because of this risk. So the economic capital has to be either be equal to regulatory capital or higher than regulatory. So I'll go on the same page when it comes to the difference between economic capital and regulatory capital. Any questions? We can move on. All right. Moving on to the next section. We look at the credit risk management framework. And when you look at the credit risk management framework, they say, in general, credit risk management for loans involves borrower selection, which is the selection of borrowers by using proper rating models, and the delegation of rules that specify responsibility for taking informed credit decisions. Then the next one is limit setting, where they say set credit limits at various levels to avoid or control excessive risk taking. So most banks develop internal policy statements or guidelines setting out the criteria that must be met before they extend various kinds of loan. Then we also look at portfolio diversification, where they say banks spread their business over different types of borrowers, sectors, and geographical regions in order to avoid excessive concentration of credit risk problems and conduct proactive loan portfolio monitoring. So in order to monitor and restrict the magnitude of credit risk, prudential limits have to be laid down in the loan policy. So the portfolio quality is evaluated by tracking the migration of the borrowers from one rating category to another under various industries, business segments, etc. Then they also say, when you look at risk-based pricing, Implementation of a more systematic pricing and adoption of the risk-adjusted return on capital framework enhances the organization's value. So a benchmark rate reflective of lending cost of the bank, which can be used with an appropriate markup to lend to various categories of borrowers. For example, a bank can formulate an interim risk pricing policy to price its borrower accounts based on the rating category. So a robust credit risk pricing model needs to generate a credit term structure consistent with empirical properties. So banks should be looking to formulate pricing models that reflect all of the costs and risks they undertake. So the pricing model should be realistic, intuitive, and usable by the business people. On the next section, we also look at credit risk management framework should enable the top management of the banks to know which, when, and how much credit risk is accepted to strengthen bottom line. So it constitutes the following steps. Identify the risks, which is data capturing and identifying the drivers through various rating models. Measure the risks, which is assessing in terms of size, timing, probability for which the bank should have proper systems and tools in place. Then manage or control the risks, and based on the measures, various reports can be generated that help the management in avoiding, mitigating, offsetting, and diversifying the credit risk in various portfolio segments. Then monitor the risk, which is categorizing significant changes in the risk profile and controls as well. And we are going to look at this in more detail when we look at the credit process in Whitney as well. And the lecture allows to ask question regarding the credit process, because now it becomes an open-ended question where they say, from the organization of your choice, can you discuss the credit process of that particular chosen organization as well? And the lecture allows to go through that, but we're going to look at it in detail when we look at the chapter that is prescribed for Learning Unit 1 in Whitney. Any questions so far? Any questions? They also look at the sound practices of credit risk management, specifically address the following areas: establishing an appropriate credit risk environment, operating under a sound credit granting process, maintaining an appropriate credit administration, measurement, and monitoring process, ensuring adequate controls over credit risk. Then they also go on to say, the credit risk management process in a bank should aim at taking informed credit decisions, setting provisioning and reserve requirements against current or future levels of profitability in order to measure risk-adjusted performance, establishing minimum pricing levels at which new credit exposures to an obligor may be undertaken, pricing credit risky instruments and facilities, measuring the regulatory capital charge following standardized or IRB approach, measuring the actual risk capital or economic capital, and calculating the risk-adjusted performance measures such as risk-adjusted return on capital. So please make sure that you take that, keep that in mind. The last thing that we're going to just highlight is chart 1.4, which basically summarizes the structure of the credit risk management, where they say, when it comes to credit risk management, you have the board of directors, and with the board of directors, this is where you look at the interaction with the credit risk management department, and then they now look at the loan review selection, and then they also look at the loan policy and planning. So this is all linked with the credit risk management department. Then on the other side, this is where you look at the loan department, and this is where you look at the business section, where you're looking now at where from the loan department, this section where you look at the sales, where the consultant now is going to be now trying to advertise and sell those different loans that are being offered by the bank as well. So this is basically the general structure of the credit risk management for a particular or typical bank. Are there any questions so far on what you've covered under the chapter 1 of Bandyopadhyay? Any questions? Please take note. In the next class, we are going to be looking at the assignment 1 for RSK4804. So in the next class, which is next week, Saturday, we are going to be looking at assignment 1 of RSK4804. Then after the next class, we now move on to finish learning unit 1, because the next remaining chapters in learning unit 1 is where we look at the book by C.P. Joseph and also the other book by Whitney as well. Then we're done with the learning unit 1. Then we move on to learning unit 2. Are there any questions? Anyone lost? All right, if there are no questions, enjoy the rest of your weekend. Please note that I'll also share the links to the video, so that in case there's something you missed or there's something that you want to go back to, or maybe for those who are not able to attend as well, or to attend the full class as well, I'll be able to share that video so that you also catch up as well. And for those who want to register or they want to get more information as well, I'm available. Just communicate with me after 5 and I'll be able to give you the information as well. So please note that for RSK4804, there are 3 books that we're going to be using. So make sure that you're able to download those 3 books. But please note that in the next weekend's class, we are going to be looking at assignment 1. All right, enjoy the rest of your weekend.
Thank you, bye.